Ladies and gentlemen, welcome back to Schaefer's Market Mashup. It is Tuesday, June 14th, and we are mired in another messy investing landscape. So please welcome Mark Benzaquen, the Principal of Investor Education at OCC, which stands for the Options Clearing Corporation, and he's also an instructor at the Options Industry Council. Mark, we've been talking about this for a while. It's good to finally have you on.
Patrick, I appreciate it. Thank you so much for having me.
New guest. I always like to give you the floor and talk about certain points in your career that have led you to where you are. I mean, you've had all sorts of jobs in the options trading industry. So what are some key points that led you to where you are?
Well, I started in 1997 as a clerk for a trading group on the floor of the CBOE. And for whatever reasons, I was fortunate enough to kind of move up through the ranks over the years in my 17 or 18-year career at the CBOE, ranging from crowd clerk and transitioning over to the brokerage side, where I ran the brokerage desk as well as the pit broker in the NASDAQ and Russell trading pits. About 2015 or so, I thought it was time for a change, wanted something a little bit more meaningful in my life, and was looking to get into education. And luckily, there was a role that I was able to transition into, which took advantage of my financial background on the trading floor, as well as my desire to educate. And that's how I landed at OCC. But just like learning about options is a building block from, learning about the basics and moving up into more intermediate and advanced concepts. One concept builds upon the previous one. It's kind of the same thing with my job, that is each role that I had led me to better understanding of the options industry and trading options and managing options, et cetera. Each position that I had built on the previous one to where I am today. It's been about 25 years now in the business, and I really can't think of a better or more fortunate position for me to be in when it comes to my professional life.
Of all the various positions you've had, you spoke about broker, clerk, manager, presenter. Which one prepared you the most to dive into the educational sector of it?
I would have to say that really when I started here at OCC, I was working on the investor education desk, where we responded to phone calls, emails, and chats for people looking to learn about options, people that had questions about corporate actions, contract adjustments, stock splits, things like that. So that really, dealing with the retail investor directly, really lit the flame of my, or I should say, really added to the interest that was already there to educate, my desire to have something more substantive in terms of my career. Getting started there at OCC and directly interacting with the retail public really fanned the flames of my desire to educate, and really enhances my role today, because I deal with these retail investors on a daily basis, but also I've transitioned my role to where I'm creating online content, online courses, podcasts, manage the webinar program here at OIC, et cetera. So it all feeds into my desire to educate and to have a more meaningful existence in my profession.
Yeah, and we'll get into some of the content you guys have produced, because it's quite excellent.
Well, thank you.
To focus on more of your education, I think I did a little LinkedIn lurking. I saw, I think it was Illinois State.
Yeah, go Redbirds.
Okay.
But I did graduate with a degree in economics, and really I owe all that to my high school, really. Senior year in high school, we all had to take an economics class, and I absolutely loved it. It was one of the things that just made sense. Some subjects click with some people, and economics certainly clicked with me. And I think that really led to my interest in pursuing a career in the financial markets. So that high school economics class, I remember taking my first ever exam in college for, I think it was Economics 101, intro to macroeconomics maybe. And I got 100% on the exam. And I thought, wow, this is going to be, this college career, this is going to be something pretty easy. Unfortunately, it didn't quite work out that way. Certainly didn't finish out that way. But the idea is that, it clicked. Economics clicked. It made sense to me, supply and demand. Some of the different concepts that we learned about, through my college career. And then I, took those concepts and that interest into, my professional life. And like I said, 25 years down the road, I'm still doing it, still finding joy in what I'm doing and still getting excited about it.
So it's interesting you mentioned high school economics. I feel like I've always wondered. I went to a liberal arts school, so I took my fair share of econ classes. In fact, I went into undergrad initially trying to be an econ major. Ooh, it did not work out so well. But do you think either college or high school economics classes are diving into the ins and outs of options trading? Should they be diving into it more? Because I don't know. I kind of want to get your opinion as someone who has been around this for so long.
Yeah, I certainly wouldn't say that the high school economics classes should get into, that minutia of finance. They certainly should cover finance. They certainly should cover, the basics of investing and probably sticking to stock investing, for example. College, certainly, I think some of those finance courses, a finance major is different than an economics major. So those finance courses, I'm sure do get into options trading. As a matter of fact, I've spoken a couple times at some local universities here about options, in their finance class, visiting and doing presentations on the basics of options to some of their undergrad and post-grad finance courses. So it's definitely something that I think college students should be looking at. And certainly, one of the things that we do with our OIC webinars, there's a volume chart that we put up at the beginning where we talk about the options industry since its inception in 1973 up until now, and the record volumes that we've seen in the past couple of years. And a lot of that volume is driven by a younger audience, by a younger group of investors. These Reddit and these meme stocks that people are investing in, and they're investing in not only the stocks themselves but the options. So one of the things that I really like to do is help these new investors understand what it is that they're getting themselves into with investing with options by knowing the risks, knowing the rewards, going into it with their eyes wide open. So, your question, should schools be doing more to educate their students about options? I don't know about options specifically. I don't know that I would make that case. I certainly would make the case that both at the high school and college level, that students should have not only an opportunity, but in some cases for high school, for example, I think it should be mandatory that students learn about the basics of economics. They, learn about how they should learn how to, balance their checking account. They should learn how to, buy and sell stock. They should learn about credit cards and loans and things like that, because these are all, concepts and things that they're going to run into later in their lives. And And my gosh, I don't know anyone who gets into more credit card trouble than, college students. So definitely, I think some degree of financial literacy should be required for all, for everybody.
Well, let's dive into some current strategies
Okay.
that could be relevant in certain hypothetical situations. We were just recently, end of May, it looked like equities were starting to rally or at least consolidate for a little bit. Now, obviously, in the last couple of weeks, it's proven to be a fake out.
Right.
Everybody bit on the pump fake. So, if stocks were to recover again, what are some mechanics or strategies that a retail trader could do that would protect them from another fake out like that?
Well, an excellent question. You're absolutely right. We thought the market was rebounding, maybe a couple months ago. And recent events have shown us that not only is that not the case, but it's actually, even worse than we had imagined. If things do rebound, which, may or may not happen, certainly, there's definitely different ways that you can protect yourself. One of the great things about options is that they offer the ability to meet a number of objectives, whether you're looking to generate income, you're looking to speculate on a stock, something like that, for example, or mitigate risk. And that's, something that I really enjoy speaking about, risk mitigation, because when you talk to people that don't trade options or don't know much about options, and you ask them why they don't trade options, the number one thing that they tell you is that they're too risky, without realizing that there are actual strategies put in place specifically to mitigate that risk. And there's two types of options, calls and puts. For your viewers, for your listeners that may be new to this, buying a call gives the investor the right to purchase stock at a specific price within a specific period of time. Selling that call obligates the investor to deliver those shares at a specific price within a certain period of time. On the flip side is puts. Buying a put gives the investor the right to sell their stock at a certain price within a certain period of time, and then selling that put obligates them to buy it. The reason I bring that up is because buying a put, as I mentioned, gives you the ability to sell stock at a specific price. It gives you an exit price. So if I'm long 100 shares of stock from, say, $100, and stock is now trading, let's say 110, I've got $10 of profit in that stock. If I want to protect that profit, or if I don't want to lose money on the stock overall, I can buy a put at a exit price, at a strike price, say 105, for example. So if stock does drop back down to, say, $100, well, I can exercise my put and I can deliver that stock or put that stock to somebody else at my strike price, in this case, 105. So for, people looking to protect their portfolio, you can look at a put as insurance. We've got insurance on our cars. We've got insurance on our homes, on our life even. Why not insure our retirement assets, right? Why not insure our portfolios? So purchasing a put is one way to do it to protect that risk. Stock goes back up and you're looking to protect against another decline in the market. Maybe a put is the way to go. The problem with the put, or I should say there's pros and cons. The con to the put is you've got to pay for it, right? Anytime you buy options, you've got to put out money. You've got to outlay cash. And now there's a twist on the put, what we call a protective put when it's paired with stock. There's a twist on the protective put where you can sell a call against it. And that package, the long stock position, the long put position, and the short call position is called a collar, an options collar. So what you're doing is you're putting an exit price on your stock should it drop to where you want to sell it. You've got that exit price from the put. You're paying for that put by selling the call. So now it's almost like having insurance for free, or at a significantly reduced cost. The downside to that is now by selling the call, you're obligated to sell that stock at your strike price. So if we had the example, stock was trading 110, we put a 105 put on the downside. We sell, let's say, a 115 call against it to pay for that put. Now, if stock drops to 100, we go ahead and exercise our put and we sell shares at 105. If stock, on the other hand, goes to 115 or beyond, because we've got that short call, we're now obligated to deliver those shares at 115. But keep in mind, we bought the stock originally for 100. It was trading 110 when we enacted this position. So if it drops down to 105, we sell the stock. We've got our $5 profit there. Stock goes to 115, we sell our stock. Now we've got a $15 profit there. So by either purchasing a put outright to cover the stock or to protect the stock, or to pay for that put by selling a call against it through the use of the collar, those are two very widely used strategies that investors use to protect their position, and two of my favorite option strategies out there as well.
Yeah, you did a great job there, I think, of highlighting the massive degree of customization
right
out there. It's so you are taking complete ownership of your portfolio through these strategies and mechanisms.
Well, and that's the thing. You make a great point. You're taking ownership because investing in options isn't like investing with stock. It's not typically a set it and forget it strategy. You don't just buy an option, put it in the drawer, and then, see what happens come expiration. Options require vigilance. They require management, maintenance. They require you to see what's going on with the market, see what's going on with a specific sector, and see what's going on with your specific stock and manage that position accordingly. Now, sometimes you don't need to do anything, right? It could be a set it and forget it strategy, but if the market is going against you, it behooves you as the investor to, manage that position. There's, oftentimes that, we get contact from individual investors about, say, a corporate action that they didn't realize was occurring, a merger, a stock split, something like that, dividends being paid. And that leads to unexpected consequences with their position. And what I always tell them in a very delicate way is, look, it's your money. You need to be the steward of this money, right? No one else is going to be looking out for you. Your broker isn't going to, be looking out for you on a daily basis to see what's happening. It's your money. You need to take a long, hard look at what's going on. Be aware of what's happening with your stock, with the market, with the sector, et cetera, and manage that position accordingly. No one's going to do it for you.
Mm-hmm. Very well said. So you mentioned before the content that you're producing over there at OIC. Mm-hmm. And I saw on your LinkedIn a great YouTube video on bull call spreads. I think it was last week, which was perfect timing because over here at Schaefer's, we are soon rolling out our own vertical product. So at least to start, explain to listeners, what it means by like a vertical strategy, and then elaborate a little bit more on the bull call spreads.
Okay. So there's simple trades, and then there are complex trades. A simple trade is simply buying or selling a call, buying or selling a put, one leg, one trade. A complex trade is where there is more than one leg involved. You're buying a call and selling a call. You're buying a put and selling a put. When you do, and we call those spreads. When you are doing a spread in the same month, but a different strike, that's called a vertical spread. So for example, you're buying a $50 call for a August expiry and you're selling a 55 strike call for the August expiry. That's a vertical spread. If you are buying a $50 call in August and selling a $50 call in December. That would be a calendar spread or a time spread. If you're buying a $50 call in August and selling a $55 call in September, that would be a diagonal. So different strikes, different months. So the way that we look at it, same expiration, different strikes is a vertical. Different expiration, same strikes is a calendar. Different strikes, different months is a diagonal. Now with the bull call spread, it's a form of a vertical spread. So you got the same month expiration, but different strikes. You're buying a lower strike call, such as the $50 strike, and you're selling the $55 strike, again, of the same month, same call. That's a bull call spread. And the idea of a bull call spread is that, as the name implies, you're bullish on the stock. You think it's going to go up. And so you could just buy a call outright, which a lot of investors do. They're speculating. They think the stock's going to go up, so they buy a call option. And let's say that $50 strike costs $3 in premium, so $300 in real world money. The idea is that you think the stock is going to go up beyond $50. Actually, you think it's going to go up beyond 53, because that would be your break-even point. If you were to buy stock for 50, but you paid $3 for that right to purchase the stock, you're actually paying 53. So that's the idea of buying a call. Now, the way that I like to explain it is what that call gives you the right. It gives you the ability to participate in any upside movement of a stock from your strike price, theoretically, to infinity. Right? There's no upper limit on it as how high a stock can go. But when was the last time you saw a stock trading for infinity? Right? They're not going to go that high. So let's say I thought the stock was going to go from $50 to, say, $55. It's not going to go to 60. It's not going to go to 100. It's not going to go to 1,000. If I only think it's going to go to 55, then why am I purchasing all of that extra upside potential when I don't need it? And that upside potential costs money. In this case, it costs $3. If I only think it's going to go to 55, I can sell that $55 strike, and maybe I'm able to sell that for $1. So now my net debit of the trade, I bought the $50 strike for $3. I sold the $55 strike at $1. Now my net debit is $2, right? Which is what, 33% less capital I have to come up with. It also gives me 33% less risk, because now I'm only at risk of losing $2 as opposed to losing $3. The drawback is that if stock does go beyond that $55 range, then I'm going to be selling the shares. So if stock closes at $60, let's say at expiration, I buy stock for 50. I'm obligated now to sell that at 55. So I've made a $5 profit on the stock. Minus the $2 that I paid for the spread, I actually have a profit now of $3. So if the stock goes beyond my short strike, that's going to be the limitation. I'm not going to be able to participate beyond that strike. But the idea is I didn't expect it to go there to begin with. So it is a win-win situation, assuming things go right for me. If stock goes down to $45, right, and now my forecast was entirely incorrect, stock didn't go up, it went down instead. Now I'm only losing $2 as opposed to losing $3. So my risk is limited, but my reward is limited as well.
It's the most efficient way, I feel like, to allocate your capital when you're making this play.
Yeah, certainly. It's when you look at a professional trader, professional market makers, they love spreads, that defined risk, defined reward. It's a way to potentially profit from your forecast and your motivation, but it also limits your risk. And as you know, limited risk means limited reward. Mm-hmm. So when you're, so obviously just like anything else, it's a balance. There's going to be a trade-off. If you're getting something in one hand, you've got to give it away in the other.
Yep, absolutely. And especially in the current market ecosystem we find ourselves in, where there's not a lot of upside, something specific like that bull call spread does seem like a prudent route. So
and then you can flip it with the bear call spread, right? You think the stock is going to go down, you can do the bear call spread, but by selling a call, now you've got unlimited risk. I should say significant risk, because again, there's no telling where that stock may go. So by adding another leg to a spread, whether it's a bear call spread, bull call spread, bear put spread, bull put spread, what have you, by adding that other leg, it really limits your risk, typically limits your reward as well. But from a risk mitigation standpoint, which again is one of my favorite things about options, and is very timely in the market, as we're seeing with the streets running red with blood of these share prices that are falling. Risk mitigation is definitely something that I think a lot of people are going to be looking
at. Absolutely. I've got, I'd say 3 questions left. We can just get to them rapid fire here. And
okay.
We'll get you out of here. First one's a broader, we've gone very deep into this. We've been very surgical so far with the questions. A broader, what is some life advice you have for retail traders, options traders, about staying in the market right now? Because you got to have a strong stomach. And I might have just said the advice myself, but what do you have for them?
Well, you're right. You definitely need to have a strong stomach. And while I am precluded from making recommendations or providing advice,
of course,
I will tell you that I am of the opinion, and it is strictly my opinion. Well, let me put it this way. I oftentimes look to Warren Buffett. Warren Buffett is famous for saying, when everybody's selling, you should be buying. When everyone's buying, you should be selling. I guarantee you there are plenty of people out there right now that are buying in this market and feel that the market is on sale. Stocks are on sale right now. Options are on sale right now. And a lot of people are getting into the market based on that. Smart money, for lack of a better word, might say that now is the opportune time to get into the market. But doing so, when you invest at any time, right, you should have a degree of caution. As I mentioned before, these aren't set it and forget it strategies. So regardless of whether you're in a bull market or a bear market, you're going to want to monitor what you're doing. For new investors out there that are just getting their feet wet, a lot of people say that it's best to start small. It's best to start slowly, kind of see what happens. Certainly don't invest more than you're willing to lose, right? And I think these suggestions or these ideas apply regardless of what market you're in. For lack of a better word, that's what I would go with. Start, go small, go slow, make sure you know what it is that you're getting yourself into, and always seek out an advisor, seek out your trading firm, your brokerage firm, talk to them, and get all of the education that you can. Make sure you know what it is that you're getting yourself into.
Start small, start slowly. That might be the episode title here in post-production. So
I like that.
2 more questions, and they're fun ones. Did a little Instagram deep dive. Looks like you're a big drummer, music guy.
I am, yes, sir.
So really quick, I don't want to hear explanations. Just rapid fire. Your top 5 favorite drummers. Go.
All right, Neil Peart from Rush, who sadly passed away about a year and a half ago. It was the first celebrity death that actually affected me. Mm-hmm. John Bonham, Led Zeppelin, Keith Moon from The Who, Stuart Copeland from The Police, and number 5, boy, there's about 1,000 of them, Number 5, I'm going to say my childhood friend from a band called Rage Against the Machine, Brad Wilk.
Wow, a childhood friend.
Yes.
No way.
Yeah. Yeah. Sadly, they're coming to Chicago next month, and I'm going to be out of town, so I'm not going to be able to catch their reunion show. But yeah, I've seen them several times.
I will not also be able to attend. I looked into it. I was so excited when they announced, and the logistics never worked out for me.
Yeah,
but no,
I've got a few shows like that this summer that things aren't quite working out. So I'm moving the pieces around. 2 years without concerts is long enough.
Absolutely. No, that's great. I like that list a lot. I think the only addendum I would have had is maybe Dave Grohl, but is he really a drummer now? That does, we can. That's episode 2.
Yeah, but again, Taylor Hawkins, a great drummer, great energy. Very, very sad to have seen him pass.
Yeah, sad stuff. Okay, so to wrap up, we got Mark Benzaquen here, the principal of investor education at OCC, also an instructor at the Options Industry Council. To close and sign off, what's going on at OCC and OIC lately? I'll give you the floor here. You got 3 minutes on the clock. Plug what's been happening.
Well, I think one of the most exciting things that we've done recently there is, as I'm sure you know, when an investor first opens an options trading account, they need to receive a document called the Characteristics and Risks of Standardized Options. We also call it the Options Disclosure Document, or ODD for short. The ODD has been a document for the past 15 years or so that there's been supplements and addendums made to it, so kind of piecemeal thrown in the booklet. Long story short, OCC underwent a project where we completely rewrote, for lack of a better word, the disclosure document, encompassing all of those addendums in a single document, making it more streamlined, a little bit more easy to read. So we released that in, I believe, August of last year. My team, and specifically myself, took on a project to do what we call a quick guide to that ODD, where we kind of summarize a lot of the information in there, make it much more digestible, more interesting to read, more appealing visually, and simplifying the document as a whole. Now, it's certainly not a substitute for the ODD, more as a companion piece to it. So for the last several months, that's what I've been involved with, designing that guide, and it was now just released a couple of weeks ago on our website, theocc.com, and the OIC's website, optionseducation.org. And so it's something that we're very, very proud of. We think investors will get a good amount of use out of that. And then I've also been creating new courses for our OCC Learning Center online. We just released a course not too long ago explaining about the options Greeks. There's another course that I'm finishing up now, hope to have released within the next month or so, that's going to be all about options volatility. And then I'm scripting the next course, which is going to be some of the things that we talked about today, option strategies paired with stock.
That's amazing. We're running out of time here, so thank you so much, Mark. I will include the links to both OIC and OCC. Thanks again. Can't wait to have you on for another episode.
Patrick, I appreciate this. It was a lot of fun. Thank you.
Awesome. Thank you. Take care, Mark.
You too. Thank you. Bye.